profit at all. All right, so now we'll turn to commodities as an asset class. Commodities, what are they? Well, mostly it's energy. It's crude oil, it's natural gas, and it's coal. Those are the biggest components of the commodities in terms of a dollar volume of what's traded. But you also have other types of commodities, precious metals, platinum, silver, and the like, aluminum, copper, iron, and steel. You also have food and consumer products, corn, rice, coffee, tobacco, sugar, orange juice, and you also have cotton, wool, timber, and rubber, and also cattle, feeder cattle, live cattle, and lean hogs. So those are just an example of the types of commodities that are out there. Why do we call them commodities? And the reason for that is, for the most part, let's say you own a barrel of Brent crude oil, which basically is oil that came from basically off of England. Right? If you own a barrel of oil, that oil can be combined with another barrel of Brent oil and stored in a big storage tank. Right? And when it comes time for you to get your barrel of oil, they just got to turn the spigot and give it to you. So basically, commodities, for the most part, are able to be combined, if your ownership with somebody else's ownership, and stored together, and basically mixed together, and because they're all basically the same thing. There are different commodity indexes out there. One of the biggest indexes, the longest standing index here, is something called the GSCI index. It's been around a long time. Uh, One of the criticisms of that index has always been that it's dominated by oil and natural gas and coal. So we have this other index. It's now a Bloomberg index, I believe. It's changed names over the years, where they basically cap how much you have in any one sector. So you have energy, you have grains as a much bigger part of that, livestock, precious metals, and the like. So that's a little bit more diversified in terms of the index itself. So if you're looking, for example, to invest in a commodity index fund, you have to be careful what index that you're actually tracking, because the components will be different. The risk and return of commodities, this is just one chart. It basically shows that commodities have a fairly high standard deviation and a fairly low return over the long term. Commodities basically, if you read the Rick Ferry book, you would have seen that he doesn't like commodities as an asset class because, quite frankly, the rate of return for commodities doesn't really exceed that of inflation by a very large margin, but it's very volatile. So even though you can invest in commodities, basically the way that you do that is by options contracts, where you agree to accept, for example, a delivery of oil a year from now. You buy barrels of oil. Uh, when that, as the time approaches, or even on the day of that, you can still sell your futures contract to basically a refinery. So there's a very liquid market for that. So you can basically buy options to basically accept delivery of different types of commodities in the future, and you would sell them to basically people who actually use those commodities as the time for delivery of those commodities comes due. You don't actually have to worry about, hey, where is it being stored and all that. That's all handled through the contract mechanism there. And or you just go out and buy an index fund that basically owns future contracts and the like. However, commodities that's back in the 1970s actually did pretty well, and the reason for that is oil prices used to be at extraordinarily low. I mean, I remember paying gas back for like 12 cents a gallon and things like that. But in the 1970s, we had two big oil shocks. And OPEC basically limited the amount of oil that was being pumped. It led to some gas shortages twice in that decade, and oil prices went up significantly, as did other commodity prices. And so commodities basically outperformed the stocks in that time period. Since then, commodities haven't done extremely well. they they did go up quite a bit in value in the first part of the 21st century, but when the great financial crisis came along, they went down significantly. And part of that is because oil had reached $150 a barrel. Uh, by comparison purposes, at the start of this year, oil was trading around $50 to $60 a barrel. And as of right now, oil is trading below $30 a barrel. Here we are at basically the start of another recession, in essence, caused by the coronavirus. But also, there has been a breakdown in terms of OPEC. Saudi Arabia has said we're going to pump as much oil as we want. Uh, Part of that is because of Russia basically not agreeing to limit production. So there's some strategy going on in the oil markets and the like right now that has really driven down the price of oil. So uh, basically, what we see is really fairly lousy returns in commodities over the last 10 years or so. So are commodities a good investment? Um, Roger Gibson, who wrote the book on asset allocation, really likes commodities for use in their portfolios because over the very long term, they actually have a different correlation to stocks and to bonds. Um, it can be either extremely low correlation or negative correlation, but that's again, it's not always the case. That low correlation didn't work back in 2008. They do have very high volatility, and over the very long term, low expected returns. I think another reason I'm personally suspect of commodities as an investment is basically there's a substitution process that goes on. For example, oil. Um, if we look at that 30 years from now, there probably won't be a lot of oil being pumped. Um, we're always seeing a decline in coal production. Natural gas production will probably continue for a while, but even that might stall as we shift towards renewable energy. A lot of the precious metals, like lithium, for example, that's used in a lot of car batteries, there's a lot of new developments going on there where they're finding basically ways of using lower cost metals than these high cost metals, high cost in terms of both uh, their the cost to produce them, but also the fact that they're relatively rare. There's only a few places in the world that you can find some of these metals, and that tends to drive up the prices, especially when demand goes up, but the supply hasn't adjusted yet. So you have some alternatives coming into play, and for that reason, I'm not a big fan of commodities for that reason as well. You already have some exposure to commodities just by owning stock. For example, you're going to own a mining company that mines different metals. You're going to own ExxonMobil stock as part of an index fund. So you already have exposure to some degree to commodities, for example. Um, and as we've seen, they're not a perfect hedge against stock market downturns, certainly not back in 2007 to 2009. However, a lot of investment advisors do believe in commodities, that they should be part of an investor's portfolio, and they make the portfolio more efficient um, in that regard. Modern portfolio theory might suggest that they be part of a portfolio, but again, because of their low long term rate of return and high degree of volatility, I'm not a big fan of them. So let's discuss hedge funds. Wow, here's something entering Greenwich speed limit 2% and 20%. All right, we'll